Okay, welcome everyone. It's Jason here again from Alliance Corp Property Experts. Got another great quick video for you. This is a question that we're asked all the time when clients come in. Jason, I'm here today because you're going to tell me where the best location is, right? So whether it's location or yield, the question is for you, what should you be chasing? So in this video, what we're going to be looking at is the 3 tips to identify what is the best strategy for you, growth or yield. Okay, now, as I said before, most people think it's all about location, or if some people are chasing yield, they think it's all about yield. The question I put back on my clients was, hang on a minute, maybe you might be approaching this the wrong way. What I would suggest you first start off is, what is your why for investing? And what I mean by that is, what are your goals? All right, why are you looking to build an investment portfolio? Because that will help you identify what sort of strategy you should adopt. But also too, what is your current financial position? All right, how do the banks see you, or how do the banks consider how much money they're going to lend you based on your current financial position? These are the 2 things that you should be focusing on, not scrambling online or reading all the newspapers to work out which is the next big hotspot. And I'll tell you why. So if we focus on the first point, your goals, you know, what is the point of someone focusing on a high growth strategy if what they need are yields? For example, take someone in retirement. If you're close to retirement and you already have assets and you already have equity in your home, or you might already have investment properties, when you retire, you're going to lose your income, all right? You're going to be relying on either the pension or some super. You really want to look at ways of replacing the income. You want assets or investments that are going to generate high yielding cash flow positive income, all right? That's what you want from retirement. So it makes no sense to buy something in a high growth location where the rental yields are so low that not only do you not get the cash flow positive income, you actually have to top that up as well and take into consideration you're not working, therefore you're not getting the tax credits, and you'll have more negative cash flows again. So that just doesn't make any sense. The same goes for a young professional couple on a very high income that don't have assets. They're looking at wealth creation. They don't need properties with high yields because they've got their income from their jobs to support that, but also too, their high income supports their borrowing capacity. They really are after that capital growth, build the equity, pull the equity out, buy more properties, etc., etc. And then of course there's a low income earner. What do they want? Well, they just simply might want to look at replacing their income. All right, that might be a real focus for them. However, a consideration must also be their borrowing capacity if they want to go on and build a portfolio, which takes us into point number 2. So number 2, what is the strength of your current personal financial position, and why is this so important? It's your borrowing capacity. It goes back to what I said before. If you want to build a portfolio, you know, the banks aren't lending you money based on the future performance of your portfolio. They're lending you money today based on your cash flows. That's your personal cash flows. That's the cash flows of the property. And as you know, to achieve significant wealth and significant financial goals through property, 1 or 2 properties aren't going to cut it. So whatever strategy you're looking to implement, it has to be based on the fact that you can replicate it, you can keep going back to the banks in the future, and they're going to keep lending you the money. So if you think about a low income earner who wants to build a portfolio, well, they've got to focus first on cash flows to assist with them getting into their next property, with capital growth being the second focus. As for high income savers, high income earners, as I mentioned before, capital growth is their focus, with yield being their secondary consideration. Now, there is something that can change this dynamic, which takes us into point number 3, and that is, what is the strength of your financial position in the immediate future? So for example, our property consultants, they're property wealth planners. We're not just thinking about what's in front of you in terms of your next purchase. We're thinking about what you need to do with the next purchase to help you get into the next property and the next property. And also we're asking questions about your personal circumstances, because that weighs heavily on, again, your ability to get finance. So by simply asking the question, do you see any significant changes that might impact your ability to borrow or invest in the future? What might those be? In this example, we're dealing with a low-income earner where initially, with a lot of debt on their home and a low income, they could only afford 1 property at a low price point, and we had to target something with high cash flows, all right, that would support their ability in the future to get into their next property sooner. But because we asked the question, what does your immediate future look like? Well, they divulged to us that they're receiving an inheritance, which would pretty much wipe out a lot of their mortgage, which significantly increases their borrowing capacity and frees up some equity. And on top of that, they were getting a significant pay rise at work. Well, then that changes the strategy. So now we've moved from a single purchase, low entry price point with cash flow positive income. Meets the requirements at the time, but not good in terms of generating a lot of capital growth early on. With the new information that's been presented to us, we're now looking at something that is more focused on capital growth with less of a focus on yield. But then the second property, which we'd buy at the same time to speed up the results, we might focus on something that's neutral. So it's got the best of both worlds. There's a little bit of capital growth there, but there's some also enough rental income or enough yield there to cover the costs. So we're not impacting their borrowing capacity too much, but we've got more capital growth potential in both those properties to fast track their wealth creation. An important note too, that because their borrowing capacity is dramatically improved through their changes in their personal life, we can target properties at a little bit more of a higher price point to get you a better quality property and a better quality location. So as I mentioned before, it's not just about, which is the best location, which has got the highest yields. As I say to a lot of clients, if that's what you want, that's great. Go buy a property here in Middle Park. We're in Melbourne. Middle Park, that's one of the best performing locations and will continue to do so. Well, that information is useless to you because most people can't buy there. The properties are $1 million properties. The rental yields are so low that the bank are probably not even going to lend you any money for it. So what is the point of giving that advice? No, it starts with your financial goals. What are you trying to achieve? And it also starts with your current financial position, your immediate financial position in the near future, if there's some significant changes there, and the cash flows on the types of properties that you're buying. That needs to be the main focus if you want to build a portfolio of properties to achieve those financial goals. Hope that was helpful. Guys, if you want to learn more about this stuff, book yourself in for one of our complimentary strategy sessions with one of our property wealth planners, and they can go through and have a look at your goals. They can have a look at your borrowing capacity and show you long term how the banks would view you in terms of helping you buy multiple properties over time. Thank you.